all your flights. So I'll stick to the allotted time, and I promise we'll make it good. So just a quick overview of what we'll be covering today. So within our firm, I primarily cover our European allocation. Our strategy essentially is we manage equity strategies where we're looking for microcaps specifically that are cheap, levered, and are in the process of paying down debt. If that sounds familiar, it should. That's essentially the private equity formula and the standard setup of an LBO. So that's essentially what we'll be looking at, and we'll be discussing how this applies to microcaps in Europe specifically, because we see a lot of really good opportunity in Europe. So I'll start with just a basic overview. You're obviously, finance professional, you're familiar with this. But in a nutshell, right, mathematically, if you want to earn a high return within equity markets, really there's only two ways to do it, right? One is you either purchase a stream of income at a substantial discount, a la the classical value approach, right? Or you pay the market price for something that's going to grow really fast or faster than expected, right? So that's essentially perhaps your growth at a reasonable price strategy, right? Now there are challenges to both of these. And for folks here in this room who are familiar with microcaps, I don't need to go into too much detail about it, but for example, the challenge with the value approach would be that you can buy something that's really cheap today, and then it stays cheap for a long time, right? I think a lot of us may be familiar with that over the past years. But on the flip side, in terms of buying something at a market or fair price and having that grow faster than expected, there are a number of really serious challenges to this, which often go overlooked. Number one is that turns out it's actually really difficult to forecast growth. Actually, quite difficult to forecast growth accurately. So we looked at this. There's a paper, good paper that was written in the late 90s by one of the co-founders of LSV Capital out in Chicago. It's called The Persistence and Predictability of Growth Rates. And essentially what they looked at was when you measure the companies that have above median growth, say over 1 year, 2 years in a row, 3 years in a row, 4 years, 5 years in a row, the question they asked was, is that any different from a coin flip, right? So with a coin flip, the odds of flipping heads once is 50%, odds of flipping heads twice, 25%, 3 times in a row, 12.5%, and so on and so forth, right? So they did essentially the same analysis for companies, looking at what proportion of companies are above median 1, 2, 3, 4 years in a row. Turns out, obviously by definition, for 1 year, 50% of companies are above the median. Okay, great. That's what you'd expect by definition. What about 2 years in a row in terms of the overall market, right? What proportion of companies are above median 2 years in a row? Actually, it turns out to be pretty close to 25%, right? Pretty much exactly what you'd expect by chance, right? Got even further, 3 years in a row, 13%, 1-3, of companies are above median in the earnings growth 3 years in a row, right? Pretty close to that 12.5% figure that you'd expect purely by chance, right? And the pattern holds for 4 years in a row, 5 years in a row. It's basically indistinguishable from a coin flip, right? So predicting growth is actually really, really darn difficult. So what does persist over time, right? Because at the end of the day, if you want to buy something that's cheap, you have to have it being that price being anchored to something that is going to stick around for a while. Another good paper that's been written was by Novi Marks in 2010 on gross profitability, right? And it turns out that gross profitability, defined as gross profits relative to assets, actually does persist over the next 3, 5, through to 7 years, right? And the reason it persists is because it's a measure of productivity, right? So unlike margins, where if you've got high margins, you attract competitors, which brings down your margins, at your expense and in favor of your competitors, right? Or if a company is going through a difficult time, usually they'll fix whatever challenge they're facing in order to improve their margins. So margins are mean reverting, but productivity tends to persist. Many of you will know this, for example, if you're hiring an intern, right? One of the main things you look for is like a high GPA. Why do you look for a high GPA? Right? Because you fully expect that somebody who's productive with time, resources, and other resources in college will be productive when they come and work for your firm, right? So productivity is one of those inherent things that's you can expect to persist. Because it's an indicator that the company is either very well managed or it's in a business that is productive in terms of generating profits from assets. Right, so we can look at this. So gross profitability seems to have some promise, right? So now we can look at this globally in terms of if we say, okay, we want highly productive firms and we want to buy them at a lower valuation. Let's see where in the world we can find the best mix of highly productive firms that are trading at cheap prices. And as it turns out, Europe stands out amongst all global regions in terms of the cheap stocks being highly productive in terms of generating earnings from their assets. So over here we've split out the global developed markets into Europe, Japan, and North America. And the dots above the bars are essentially the gross profits to asset level for the entire market, right? So let's focus on the GP to assets chart for now. What you find is that for each of the three markets overall, it's around the same, right? So in North America, you've got median asset productivity around 20%, right? In Europe and Japan, it's slightly higher, but broadly in the same area at around 25%. That's for the overall market. In the bars, what we did was we looked at within each market the companies that are trading at a discount to book value, right? So trading below 1 times price to book, right? That's what we defined as a value stock in order to be consistent across markets. And what you find is that for those value stocks in Europe, you're getting gross profits to assets of essentially 19%. And now compare that to the US, where you're getting 13%, right? So in a nutshell, what you see is that in Europe, the value stocks in Europe are of significantly higher quality, right, than in the US. And that's part of it is due to the valuation story across those markets, right? Since Europe has been neglected for quite a while now, over basically since the trade wars in 2018, then COVID, then a war in 2022, and then at the end of 2023, a war within the region that's blocking the Suez Canal, right? Europe has kind of been bumping against one crisis from another. So as a result, you just have more high quality companies that are dropping into the value bucket, right? So if you're looking for value stocks within Europe, you actually find higher quality companies compared to other regions. Next to that, we also defined it just for robustness. We wanted to define quality slightly differently to see whether the results hold up, and they do. So in terms of EBITDA to assets, you see essentially the same story. Europe really stands out in terms of its the productivity of its companies, especially within the value bucket. Right. So I mentioned earlier that a big part of this is tied to the overall valuation story, right? So over here in this chart, we're measuring European valuation spreads. So this is the spread in valuation between, in terms of price to book, the spread in valuation between your European growth stocks and your European value stocks, right? And from where we're sitting today, right? This chart shows that series over the longest series of data that's available, starting in 1975. And this data is from Ken French's website. So since 1975, which is the longest series of data we have available for these spreads, we're currently sitting at the widest valuation spreads in Europe, essentially in recorded history, since 1975, right? Another way of looking at this is that standing today, your value stocks in Europe, especially relative to growth, the market is basically saying that things are as bad today as they were in the dark days of COVID, right? Essentially, right? Which doesn't quite seem to make sense, right? So our view, and I think based on the pattern you can see here, that this is a mean reverting series, right? When spreads get super wide, they tend to gravitate towards the center. And that's what has occurred since 1975. And the key thing is that, like, once you get to these extremes, when the rebound happened, that favors a value pretty significantly, as you can see on past occasions, where value would then outperform growth by a hefty margin over the next 10 years. So we tend to think that we're on the cusp of another good decade for value, particularly based on where these valuation spreads are today at historically extreme levels. And then within, and the story gets even better when you're able to focus on small and micro-cap companies, right? So this looks at the distribution of equities by size, European equities by size, right? And if your fishing pool is essentially smaller micro-caps, your selection opportunity is essentially 4 times larger than the big guys, right? So the folks who say, okay, I'll only look at something that's 2 billion or above of market cap, right? So to the extent that you can say, okay, I'm going to focus on smaller micro caps, you've got a much larger pool of opportunities to select from, and that in and of itself creates part of this disparity in valuations, right? Because if you've got a ton of money that's focusing on the large cap space, so 2 billion and above, right? So it's all being concentrated in essentially 20% of the opportunity set, right? That'll naturally drive up prices amongst those, mid to large caps, whereas your small and micro caps are going to be cheaper because essentially you've got essentially relatively less money chasing a much larger pool. So from a expected return standpoint, it's good in some ways to be fishing relatively alone amongst smaller micro caps, because the opportunity set is so much larger and you can be more selective. All right, so since we're talking about European companies, I had to give an example that is consistent with what you'd imagine for a European firm, and this would be Savencia, which is a French cheese company. So we met with this company in October, and it's a company we've held in our portfolio for since 2020, and from its market cap and also its revenues, right? This would probably be more defined as a small cap rather than a micro cap, just based on its revenues alone. So it's a global company. It generates 7 billion of annual sales across 120 companies, right? So earlier, in one of the earlier presentations, one of the gentlemen talked about small cap giants. So this would be one of those, right? So it's got global reach and generates $7 billion in annual sales across a very diversified set of end markets, right? But what makes it closely related to microcaps is volume. So because it's a family-owned company, the free float is only 26%. And as you can see, the average daily volume is 80K, right? So earlier in one of the presentations, there's quite a bit of discussion about a trading volume and how that can be an issue for microcaps. And here's a classic example, right? So for this, if you're trying to put 500,000 into the stock, and you don't want to buy more than 10% of the trading volume, it'll essentially, you just need to be patient, right? So it'll take about 3 months to build a 500,000 euro position in this one. But what do you get in exchange? I mean, the numbers really speak for themselves, right? So the valuation for this global company is only 4 times EBITDA, right? Around 8 times EBIT, trading at half of book value, right? So largely because this thing has got low volume, it trades at a ridiculously cheap price, and it trades at 0.7 times tangible book value, right? So either way you look at it, this thing trades at a discount. And when we met with the company in October, I asked him, why is your stock so cheap? And he said, and he kind of sniffed in his classic French style, and he said, for me, it's a shame that the stock is so cheap. He said, we generate $7 billion in 7 billion euro in sales. We got leading positions across all of our end markets. I've spoken with some of the bankers, and they say that just because we're under $1 billion of market cap and we've got limited volume, fund managers won't even look at us. But if that's the case, I just consider it a shame. To which, I as a fund manager found that to be welcome news, because it just means that there's a really good opportunity to buy this thing at an attractive valuation, and you actually get paid. You get paid to wait until either liquidity improves or the multiple goes up, because this company, it pays a dividend, its earnings are growing at a very reasonable pace, very limited leverage. And when you look at its profitability, as we were talking about earlier, gross profits to assets is essentially 47%, right? Compared to the market median is about 30%. So this is really shooting the lights out in terms of profitability at a substantial discount. So the good news is, in microcap land, for folks who are looking for excess returns, there are tremendous opportunities to find companies that are highly profitable, trading at cheap valuations, and those opportunities tend to abound in Europe today. And with that, I'll just open it up for any questions, to the extent there are any.
Thank you for coming.
Yes, sir. Thank you for having me.
Did you do a study? A few questions real quick. I know other people. Very interesting listening to you. Did you ever do a study of the dividend growth stronger in Europe or more stronger in the United States? I think the United States. What do you think? And then, when do you think these European stocks are going to come back? You say it's in a doldrum. I agree with you. They're flat. What year? Or what's, those two questions.
Great question. So I'd say in terms of dividend growth, it would be, I agree with you, the growth in dividend will probably be higher in the U.S., just because earnings growth is higher in the U.S., right? So for your typical value company, it's going to be growing essentially at the rate of nominal GDP, for the most part. So GDP growth rate in the US is higher than Europe. So and that would translate to dividend growth being higher in the US relative to Europe. Now, that being said, when you look at the dividend yield, right, the dividend yield is higher in Europe than it is today, right? So so the dividend yield in Europe today will be around, you can get it easily in the value space, you can easily get a 4% dividend yield in European value, right? In the US, maybe you're looking at 2% or so. So your yield is significantly higher in European value today. So that leads to naturally to your second question, right? If you're going to invest in Europe, it's a market where you're essentially getting paid more to wait for multiple expansion, right? So necessarily by investing in Europe, you just have to be patient. So I don't know when the big rebound will happen. I think it'll probably be tied to whenever whenever the war in Ukraine ends, or was in the process of reaching a negotiated end. I think that could be a pretty interesting milestone to start the process for the rebound, because I think that conflict leads people to that ends up being top of mind for investors, and also has an effect in terms of affecting economic sentiment. But that being said, while you wait for a rebound, you're getting paid much more to hold European stocks relative to US. Any other questions? All right, thank you so much for having me. It's been an honor being here, and hope you enjoy the rest of the evening.